Good evening, everybody, and welcome to our spring quarterly update for landlord tax now and the future. This is the first of our quarterly series in 2019, so welcome. I will give it a couple of moments just so that anybody who is trying to get on can just get sorted. But hopefully you have had a great day. It's been good weather here in Derby. Having started in London this morning, it's definitely been an interesting day. So while everyone is hopefully getting logged on this evening, let me just pop onto our slide, which is going to tell us a bit about some of the topics we are going to be covering this evening. This is all to do with the different questions I've been having at the moment. So I've had a few questions about the interest rate restriction, which is still one of those things that is impacting people. We've got ways and things to watch for just to help you plan as we're going into the new tax year shortly. Property groups, what are they? Why can we use them? How is the best way to function with them? Some ideas on how to reduce your profits if you are working through a limited company property investment company. A few reminders then on VAT and property, and a few final bits on making tax digital, just so you've really got an awareness of what's happening and what's coming up, because obviously we want to make sure you're planned well ahead of time. So before we jump into the topics, let me just say hello. Now, here's a few pictures of me so you can see who I am, Kimberly Shapcott. And let me just give you a quick 30 seconds on my accountancy and property journey. In terms of my accountancy background, I've now been qualified for over a decade. I qualified down in London with one of the big four firms and came and joined our family practice just over 10 years ago now. So I've been working in accountancy from a general practice point of view for probably over 15 years now. So I've been around the block a few times and got some good knowledge and understanding from a general business and business tax point of view. And over probably the last 5 years, I've really been looking at some property specific and construction specific type companies that we work with. This has kind of coincided with the start of mine and my husband's property journey, which started about 3 years ago. And you can see a few examples of properties we've completed. Our general strategy is HMOs within the city of Derby, and we're now up to, I think, 5 HMOs and 1 buy-to-let, which is being tenanted tomorrow in actual fact. So we've kind of gone from having nothing through to having quite a few now and looking at continue to expand really. So I'm looking at this from my own personal point of view as well as trying to help as many clients as possible to achieve what they're trying to achieve out of their property journey, which for most of us is definitely this financial freedom and that ability to choose what we're wanting to do with our time and our resources. So let's start our topics of the evening with the interest rate relief restriction. Now, this is sometimes known as Section 24, depending how you're aware of the legislation. Now, I'm starting to hear stories of these changes now impacting landlords, especially those with larger portfolios. So for those of you just getting started, it could be a great buying opportunity. And for those with a larger portfolio, I'd just say you need to start planning how you're going to tackle these changes, really, to ensure that they're not going to have as big a bite as they could do. We're finding those with a highly geared, so lots of mortgages and lots of lending on portfolios, are having the bigger impact. Now, that'll become apparent in a moment if you're not quite sure how it's impacting people. So what I've done tonight is I've done 2 hopefully brief examples to give you an idea of how it would affect someone who's a basic rate taxpayer at the 20% and a high rate taxpayer, someone who's at the 40% tax rate. And hopefully from that, you'll be able to see why there is this impact, especially if you're at the cusp of being a high rate taxpayer. So our example for our basic rate taxpayer, I've used pretty much the average income for the UK at the 25,000 income mark. And I've just put kind of a small portfolio, maybe 2 properties, maybe 1 small HMO of 10,000 rental income, some rental expenses, and the interest paid, not the mortgage payments, just the interest that's being paid on it. So if we look at the before changes column, you can see it used to be relatively simple in accountancy terms. You had your job, you added your rental income on, you took off all your expenses, and you came down to your total income of 29,000. You take off that personal allowance that we all get each year to give us our taxable income, multiplied by 20% to get us all the way down to the bottom of tax payable of 3,430, of which some will already have been deducted as part of your job, and the rest would then be payable on your tax return. The changes themselves are impacting the way that we calculate your rental income. So in the middle of the screen, you should hopefully see total taxable rental income. Now that figure has changed from what it would have been before of 4,000 to an increased figure of 5,500, because what this interest rate relief transition rule is saying is 50% of the interest that you have paid will now no longer be allowable in full. So we've taken that out, which has increased your income by 1,500. So now the total income in this person's income tax calculation is going to be 30,500. So similar sort of approach, take off your personal allowance to give your taxable income. The tax on your job is the same, but the tax on your rental income is slightly higher. However, this is where we get the interest rate relief, which is arguably classified now as a tax credit. And it's literally 20% of the interest that you've paid. So during this transition, that is 20% of the 50%. So that 1,500 times 20% gives us 300. So as you can actually see at the very bottom of the page, the tax payable is the same. The only impact is that your total income is now actually higher. Now, your return on your investment in this example is the same whichever direction it goes. The only major impact is going to be that total income, that if you are close to the high rate threshold, which is around the 45,000 mark, if all of a sudden you were at 44,000, you might now just be over at 45,500. So let's just jump on to the high rate tax calculation, because I don't want to dwell on this for too long, but just so you can see the impact it is having from a high rate taxpayer's point of view. So before the changes, we had, in this example, just a 50,000 salary, so not too far into the higher rate threshold, but definitely over. We've got the same rental income calculations. So in this one, again, we've just got 4,000 rental income. So before the changes, the total income would have been 54,000. Take off our personal allowance, give us our taxable income. So then we can see that part of it's taxed at 20%, the rest at 40%, and the rental income now at 40%. So historically, our tax bill would have been 9,960. Under the new method, however, we have to add back this interest relief adjustment. So our income's gone up to 55.5. Take off our personal allowance. So we've again got increased taxable income. But on this occasion, before we'd have got 40% tax relief on that interest that we had paid. But now it gets taxed at 40%, and that tax credit we're getting is still only at the 20%. So in this case, our tax payable has increased up to 10,260. So it's increased by arguably £300. Now, obviously, it's not a significant amount, but it is an impact. And obviously, the more properties you have, the more income you are now having shown, the greater impact it's going to have. And your return on investment, rather than being 60% like it was before, has now gone down to 53%. So it is going to start having an impact, especially as next year that interest relief adjustment is going up to 75% in the tax year we're just going to be entering. And in the following one, we're going to be getting to the point where none of it is allowable at the top of the calculation, and it's all going to be a tax credit at the bottom. So you're going to be only getting 20% whatever income you receive. Now, it's not all bad news, because there are ways of managing this change and options to adjust your property portfolio. However, ignorance is definitely not the best solution. If you're just purchasing your first few properties, you need to generally just be aware of these provisions so that you can plan how you're going to purchase your properties so you can minimise this tax exposure. For those who already have a portfolio, you just need to do some planning. There are ways that you might be able to incorporate your portfolio, or it might be a matter of looking at ways to reduce down the debt you've got on your portfolio, whether that be through refinancing or whether it be through selling one to clear debts on another. It's very individually specific on what the best options are, because it depends how much equity you have in some of your properties and other similar considerations. If that is you, then I would definitely suggest speaking to an accountant. And if you would like to have a word, please do feel free to give us a call. Let us now moving on to increasing rental income or taking money out your company, things to watch and remember. When you have increasing income and you're taking money out of your own company, this will start to increase your taxable income. Now, as we've just seen, increasing your taxable income might have an impact on what tax you're paying, especially if it's rental income and you've got interest that you were hoping to get fully allowed. However, it's great in the long term and what most of us are looking to achieve. However, there's a few implications that you might need to consider as you're building up that portfolio to take advantage of the different options available to you. So the first one I want you to consider is, are you claiming child benefit? You might think, why is that relevant? Why is that going to be a problem? If you want to try and keep your child benefit, you need to keep your income under 50,000 each in a couple or by yourself as a single parent. If not, then you'll start to lose it and you may have to pay some back. In a company, you can manage how you take out your profits if it's coming from income, if you've got income coming from elsewhere, and you can minimize it and restrict it so that you stay under. If you have rental income, that is more restrictive because you'll have to report it each year. But it might be a consideration when you're looking at whether to buy through a limited company or whether to buy in your own name. Obviously, you're not going to get child benefit forever because children do grow up eventually, hopefully anyway. So it's not a permanent thing, but if you want to take advantage of claiming such benefits, then you may just need to restrict your income from certain locations, or you may need to look at the split of that income. So if you are a husband and wife team, you may need to make sure that whoever's the lower income earner from other sources is boosted so you maximise the income that you're both receiving. So rather than one of you earns 60,000 and one of you earns 30,000, therefore you lose your child benefit, you may need to restrict the person who's earning 60,000 if possible to 50,000 and up the other person's income from 30 to 40. So overall, you're both under 50. I will say the child benefit rules are not the most fair, but unfortunately that's what the rules are, so we just have to work within those confines. Secondly, are you claiming tax credits? Now, obviously, you don't want to be living off tax credits forever. However, if you are living on them at the moment and you're investing in property, if you start putting too much income through, you will start to lose those tax credits. Now, that's not a problem if everything's balanced out. However, if you're still investing in your properties and you don't actually have a lot of spare income from that investment, then losing your tax credits might have a bit of an impact on what you're doing. So again, it's just really looking at how is this going to impact our financial position to make sure you're taking advantage for you and your family to achieve what you want to be achieving. Do you have a student loan? Again, some of you may think, well, that's an odd question. People forget that you have to repay your student loan. A funny concept to some, I am well aware. But how your student loan repayments gets calculated is based on your income. So when you do a tax return, for example, like on here, when you do your calculation, it will suddenly say, oh, now you've got this much income, you have to pay more of your student loan back. So as well as the tax payable for that tax year, you will also have student loan repayments to pay, which therefore means your tax bill won't simply be 10,000, it might actually be 12,000 or 14,000 because you've also got your student loan repayments on top of it. Now, hopefully for most people, this isn't an issue, but it's just something that can get forgotten as things get dealt with and as things get balanced between spouses, as things get moved around. All of a sudden, when the tax calculation is completed, it suddenly appears and no one's taken it into account. So it's just something to be wary of so that you can make sure all of a sudden you don't get a nasty shock at the end of the day where your tax bill you thought was going to be 1,000, 2,000, all of a sudden hasn't shot up to 3,000 or 4,000. The final thing to watch out for is your tax bill. Now, when your tax bill goes over £1,000, the taxman likes to get his money early. So what I mean by this is that he likes to get some money for next year, this year. So if, for example, in one tax year, your tax bill is £1,500 and you pay that in January when the tax bill is due for payment by the 31st of January each year. When you pay that £1,500, the taxman will actually say, oh, your tax bill's over £1,000. I want some for next year, please. So what he will ask you to pay in that tax year will be £1,500 for that tax year and 50% of next year's. 50% of 1,500 being 750. So he'll actually ask you in that tax payable period for 2,250, which will include the current year's tax bill and some of next year's. Then in July, he will ask for you for some more, and he'll want another 750. The following January, don't worry, he's not going to ask you for the whole tax bill again. He's going to look at what the tax bill should be and then adjust it and say, oh, you've paid £1,500 and actually you owed me £1,600, so you owe me £100. Or, oh, actually the tax bill was £1,400, you've paid me £1,500, I'll give you £100 back. Now, obviously, it doesn't completely work that way because you're now into the cycle. And what I mean by into the cycle is it means next year he also wants some of the following year. So if your tax bill was £1,500 and next year's is £1,600, he'll want £800 towards next year's tax bill. So you get into this cycle where you have to pay your tax bill every January and July, and it kind of balances out each year. So hopefully you're paying a similar sort of figure each 6 months. The biggest problem is the first year you fall into this trap. Because in that first year, you have to pay 1.5 times your tax bill, which can be quite a significant amount. So it's just something to be aware of, because I don't want you to find you're in a struggling situation with different things happening, and then all of a sudden the tax bill lands and you think, how are we going to afford this? So let's move on to briefly property groups. What and why? So what is a property group is probably the best question to ask first. Well, this is a group of companies that is owned by individuals or an individual through a holding company. So I've got my Shapcotts Holdings Limited there. And that holding company then owns a number of subsidiaries. So other companies. These are typically owned 100% by the Shapcotts Holding Limited or Your Holdings Limited. And that company holds 100% of, say, the buy-to-let or HMO company, or 100% of the property development or flip company. The only exception tends to be your joint venture companies. So JV1, it might be you've got a 50-50 split, so we've got 50% held. And JV2, we've actually got a 60-40, so we might own 40% and somebody else owns 60%. They also tend to be directors for all of the companies as well, or maybe not necessarily all of them. You might have 1 or 2 people who are actively involved and 1 or 2 people that aren't actively involved. But you have a couple of people who are directors of 1 or both of them. Now, they're not necessarily employees of the companies, although it's generally tax advantageous to be getting a salary at a director's rate of £700 per month from one of the companies, if that is your only line of work. So if you're full-time in your property business, it generally makes sense to somewhere have a salary coming through for a few different reasons. Now, the pros of this sort of group are the limited liability. So if anything goes wrong, it's stuck in an appropriate company and doesn't come back to bite you. You can control your taxes quite efficiently this way, because you're only going to pay tax in the companies as they make a profit, and then you'll only pay tax personally when you actually take the money out of the company, which can definitely be quite beneficial. Now, you can also plan your taxes for the future. So if you've got children or grandchildren, you may be able to bring them into the holding company and you can have all of the family in the holding company. They might not be actively involved, but it's one way of spreading the wealth. So as the businesses develop and grow and the portfolio expands and wealth is created, yes, it might be your wealth, but it's theoretically, from the taxman's point of view, seen as if you all own 25%, for example, like my picture on screen, it might be 2 of them are actually doing something and 2 are actually the children. The children aren't actively doing anything in this example, but they own 50% of the company. So as it develops and grows over time, 50% of the wealth in the family has already been passed down to the next generation, which is quite beneficial, because then they're not going to be paying lots of tax in the future when something does happen to one of the older family members. In a group scenario, one of the advantages is if one company does make a loss for whatever reason, let's throw in their training costs, or it's the year that things are being set up, so there's additional charges that need to be paid. If you've got one that's making a profit, you can actually pass that loss over to the profit-making one and have a nice tax advantage that your tax bill gets reduced. So it's a good way of making use of profits and losses within your group. We tend to say you can split projects into different companies so you can manage the risks. So if you're doing new builds, if you're doing flips, depending what they are, you may want to have them in separate entities, or you might want all that type of business venture into the same property project, the same company. But it means you can manage the risks quite easily. Some of the cons: there are more companies, there are therefore more accountancy fees and more tax bills. There are greater running costs and there's greater administration because you've got to keep track of which company is doing what and where does everything need to go and all that sort of thing. And because it's through a limited company and through a more complex structure, there does tend to be fewer lenders out there that will lend to you. But it's kind of trying to find the balance of the right lending with the right choice of tax efficiency so that you can make it all balanced together. We've got some clients that own things in their own name, as well as through a holding company, as well as things direct. So it is quite flexible. Now, one of the questions I heard only earlier this week was, do I need to do it from the start or not? Can I do it later? Now, you can set this sort of structure up at the beginning. It's generally cheaper to do it that way, and it's easier to do it that way. However, obviously there's additional costs with having additional companies, and it can be done in the future. Either is generally acceptable. The only thing when you do it later is there is more paperwork and there are additional costs. But it's trying to balance out the additional ongoing costs of doing it now against the additional ongoing costs and the additional costs of setting it up later. So in some ways it comes a bit down to personal choice, and you probably say how quick you are off the mark. If it's going to take you 2-3 years to get going, you might wait a little longer and do it later. If in the next 6 to 12 months you're expecting things to go, then you might say, I'm going to set it all up now properly because then we know we're ready, we can get things moving, and it just makes life easier. There's no right answer. It's what is the right answer for you. Right, so that gives hopefully a bit about property groups. Let us move on to reducing your profits in your limited company. A few ways to reduce the tax bill in your company. Now, when you are running a limited company, the question always comes down to how do we put as many legitimate business expenses through so as not to have to incur the cost personally, as someone who doesn't have their own company would need to. Now, they have to kind of be legitimate expenses. You can't just say, oh, I've been to the food shop and I'm going to put my food shopping through. Not really a legitimate business expense. But if we look at a few of the different ones, you could consider company cars, although at the smaller end of the spectrum, they don't tend to be tax efficient through a limited company. However, when you start to grow, it may become more viable to put a company car through. But some of the basic ones that I've just put on screen are things like mobile phones. Now, this is not simply claiming it back through your company. It is actually getting the contract in the company name. That is quite important. It doesn't matter if you use it for personal aspects as well as business, but the contract has to be legally with the company. As you start to see trading profits in your rental business, this is one way to reduce your personal expenses and reduce your corporation tax bills. So you put the telephone through your business, which means you don't have to take that money out of the company to pay your personal bills. And also, the company gets a reduction in the corporation tax bill. I'd say that one is definitely a win-win when there is money going into the company that can cover the bills. Do you have children who are involved in the business? Now, this can be quite loosely linked, I will say, but they have to be doing something. If so, and you have a payroll, then you can start paying them for their work. Now, this is a way you don't have to take money out yourself. It can be taxed directly on them. And as they have their own personal allowance of 11,850 this tax year, if they're not utilising it anywhere else, it's a good way of utilising their tax bracket, a way of reducing your corporation tax, and a way of encouraging them to be responsible, entrepreneurial maybe, and getting you a tax break and reducing your personal expenses. You can also look at spreading the shareholdings, as we've just said, with our group structure, or you can do it in an individual company. This, again, it's a potential inheritance tax issue in the future, but if you bring them in earlier, then it reduces that chance. If you are slightly older and you have grandchildren as well, it could be a good way of sharing the fruits of your labour and reducing future inheritance tax bills. So that is simply achieved by sharing them with your spouse, children, grandchildren, their partners. And this then means you can maximise your income into your household each year or your families as a whole. This is obviously after you have built that original base that is needed to give that stable income. So you can't quite do it straight away, but you can definitely look at planning to do this in the future. And finally, in some options to help reduce profits, as your business develops and grows, one thing that is generally discussed, and I do discuss it myself with clients as they get to a certain point, is diversifying your personal wealth. Moving away from property if property has been your sole focus. Because if there is a big crash in the market, how are you going to survive? So there is a certain amount that when you focus for a while on one area, you may want to spread the risk. Now, one way of spreading the risk, which can be quite tax efficient, is making pension payments directly from your company to your personal pension. Now, I am no advocate for pensions. It is not something that I particularly love. However, there is quite a lot of tax benefits to making payments into a pension, and it could be quite beneficial depending on your age or depending on your income. We found a few people who are getting close to pension age or being able to access their pension pots. It could be a way of getting money out your company, reducing your tax bill. Then you can get your lump sum, tax-free lump sum, out of your pension in only a couple of years. So it could be a way of redirecting your funds and reducing your corporation tax bill. If you're further away, if you've got lots of excess cash in your company, it's a way of making it work a little harder if you're struggling to find property projects and helps reduce your corporation tax bill. So there's a few different options there. Might not be right for you, but definitely worth considering as you look at a few different aspects of things. So let me move on to our VAT reminders. Now, VAT is only relevant in certain circumstances with property. For rental income, it's classified as an exempt supply, which means that it's irrelevant. You can't VAT register, you can't claim back VAT. For residential property, there's not really an awful lot. You kind of just need to forget about it. For commercial property, it's a different story. You have a few options, such as opting to tax a property, and this is done per property. When you opt to tax, it means that you can reclaim tax on your purchase costs, but then you will need to charge your tenants VAT. So their rent will be X amount plus VAT each month or quarter. For most VAT registered businesses, this is not an issue. The only problem arises if your tenant type is going to be non-VAT registered businesses or individuals or charities, as the cost will be higher for them. So it's just a consideration of what your tenant type is quite crucial there. The options tax lasts for 20 years and then it lapses, so it's not a short-term decision. As well as the VAT on your income, your sales, one thing to be aware of, if you're not already, is VAT when you're converting a property. When you're converting a property from one dwelling to a number of dwellings, or from a number of dwellings to one property, there are tax advantages that you can use reduced rating, which means your supplier, so your builder or your contractor, can charge you 5% rather than 20%. Now, this is not something you claim the 15% difference back. You have to actively ask your contractor to only charge you 5%. They will ask you for, or should ask you for, a certificate, which is available to get online or decipher online. There's not a specific one available, but you can pull one together based on the guidance that is available online, and you give that to them to tell them that it qualifies for the reduced rating, and then when they issue the invoice to you, they only charge you 5%. So for a HMO conversion from a single dwelling to a 4-bed HMO or a 5-bed HMO, etc., your builder, your plumber, your electrician, your painter, all these sorts of things, they can be charged to you at only 5% VAT. So that can be quite useful for keeping your budget costs together. This is also relevant for properties that have been empty for 2 years before you start work. So if you are taking a derelict property, something that's not been utilised for a number of years, you may also be able to do that even if it is not changing the number of dwellings, because you're bringing a property back into use. So there's just a few tidbits on VAT, which hopefully are reminders to some people, or for anyone who's not so familiar, just give you an idea of where you might need to get a little more information to make sure you're taking advantage where possible. So let me move on to the final topic that I have noted down to go through this evening, which is making tax digital. Now, my life's very much revolving around this at the moment in the office, as well as our property clients. I also look after some of our cloud computing and VAT clients, and this is impacting them now. It's currently mainly related to VAT registered businesses. However, the ministers down in London have decided they want our economy to be more digital. They would like us to be modern and move with the times. So they have directed that over the next couple of years, we're going to become a more digital society in our business world. Now, obviously, we have a few issues to deal with before that happens. This thing called Brexit, not quite sorted yet, probably won't be sorted for a while. We'll see what happens on that front. So that might cause a few delays to this timetable, but it is going to happen. So let me tell you about a bit of what is going to happen, and then it just gives you an idea. So as you're developing the systems in your property business, you can make sure that you are going to be compliant. So when this does happen, you're going to go, so what? I already do that anyway. So the general ethos of the changes is that you're recording your information digitally and will report to them digitally with as little human interaction as possible. The returns will eventually have to be submitted quarterly, with then an additional year-end submission for the tax year to finalise the position. Now, ideally, they're looking at individuals using software. We tend to work with a software called QuickBooks Online, but you can do it through a spreadsheet and some bridging software, but it'll get a little more techy as time goes on. There's not going to be any changes to the underlying rules. They're looking at keeping everything the same. So that means that the detail won't change and the same filing deadlines will still apply. It's going to affect those who receive income through self-employment or property, which is why I'm telling you about it. What we'll need recording is the amount of the transaction, the date, and the categorization of the transaction. So it's not really the most complicated of data. Now, when is it coming? They were looking at next year. I read something earlier today where they said it's not going to be this next year. It wasn't even mentioned in the Finance Act recently. So at the very earliest, it's going to be April 2021, more likely April 2022 or later even. So in terms of what you should be doing, it's really just as you're setting things up, consider your systems. Make sure you're thinking about the future of what will be coming. So then eventually you won't really have an impact because nothing's greatly changed. There is a pilot in place if you want to get involved early. However, when you're in, it's one of those sorts of schemes. When you're in, so you'll need to keep doing it. We work with a provider called QuickBooks Online. You may have seen the adverts or the posters or the radio adverts. They are definitely out there throwing out the noise. If you do want to find anything else out about that, just let me know. Happy to share how you can get involved, as we do have some great rates for the software if you're looking at getting started on something like that. Now, in terms of how we can assist, it's really, if you do have any questions about any of the topics this evening, then please do get in touch. We will also be running a specialist webinar in hopefully May to do with development. So if you're a budding developer and you're thinking of potentially looking at new builds or things like that, then get in touch and let us know, and we'll keep your details. And as the dates finalised for this webinar, we will let you know the details and any additional information, so that hopefully you can get involved and make sure you know what you're looking at and what you're talking about when you're getting involved with these types of projects. They're slightly different to the normal flip, and they're slightly different to the normal buy and rent it out. So it's just making sure you're doing things the right way. Our next webinar will be on the 27th of June. So this will be up and available to register for after our event this evening. So if you do want to get registered for our next webinar, please do get online and get involved with that. We have a number of rental packages we offer to help you manage your costs and get the help you need when you need it, so that you can arguably manage your journey and not have to worry about the financial side of your property business. That covers off, I think, most of the bits I just wanted to share with you tonight. So we are nearly at time. I will just have a quick check to see if we've got any questions. So the only thing that I've got a brief question on is about training costs, which is one I get on quite a regular basis. So the answer to that is generally the basic training costs that we incur, things like basic training or initial training days, you can't claim, as these are just getting that initial knowledge for you. However, anything after your primary knowledge, which is expanding, refreshers, those sorts of things, we can claim. So if you've invested quite a lot into your property journey, then yes, there is the possibility of claiming that back. What we found works really well for quite a lot of clients is actually spreading that cost over the period that you're doing your training. So for some people who are doing their training over 2-3 years, it makes sense to spread that cost over 2-3 years, as we don't quite want to make any accounts look truly horrific in the first year if we can. We want to try and kind of manage the income, the profits, and the corporation tax or the personal tax side of things, just to really balance things out, to give as positive a position of your property journey as possible for you, and to manage your taxes that you have to pay towards the taxman. Now, hopefully that answers that question for you. Additional question from one of our attendees this evening. Why are you so against pensions? From my point of view, I suppose I can see pensions work more on the stock market. My preference, I suppose, has been more property. I can see the returns on that type of industry, that type of asset. I have got a small pension. I have got a few different bits and a few fingers in a few pies, because I think for me the key really has been diversification. Having looked at the state's position and how they are managing the state pension system, we've obviously seen in the last decade or so an increase in the state pension age. I think that's only the beginning. So anyone who's in their 20s and 30s, I would probably expect them not to even be seeing a state pension until they're at least 70 as a minimum. We'll see obviously whether that prediction comes true. And with an aging population in the next 20 to 30 years, with I think everyone who was born by 1960 being of a pension age by, I think, 2035, there's going to be a lot of people receiving pensions and not as many people working to pay into pensions. So I do think there's going to be some financial issues within the government, more so than there are today, which might actually mean that certain state pensions are income assessed. So I think diversification has become quite key to anyone in my age bracket to just try and manage what they're going to be able to do when they get to a point where they do want to take some sort of retirement. And to be solely reliant on pensions, which I think we found back in the 90s, the 2000s, those that were simply just reliant on pensions had a real big issue with obviously the property crash, and it crashed the stock market, and they didn't quite get what they were expecting to get. I think we need to be taking control of our financial futures and be in control of what's happening. So pensions work as part of a long-term strategy. I just think you've got to be in control of your strategy. So hopefully that gives you a bit of insight from where I'm coming from. Obviously, different age groups, different personal situations, different financial advisors, to be honest, have different ideas on different things. So it's just what's your opinion is what really matters with these different things, and making sure you're going to achieve what you want to achieve in your future. Now, at that, we've run a couple of minutes over, but if there are no other questions, then I will sign off for this evening and let you go and enjoy the rest of your evening, and say thank you to everyone who has joined me this evening. Hopefully you have found the information useful and got a few ideas or a few reminders or learned something new. And I look forward to joining you in 3 months' time for our summer update, and we'll see what's happening at that point of the year to hopefully make sure everything is still on track with your property journey. Have a great evening.